Hello everyone. This is a kind of initiative made by Nesto Institute. We like to give you a complete understanding on accounting basics. This the series of videos aims for basically to educate the non-commerce, non-accounting, non-finance background students. So we will be starting from basics and helping students to understand the basics of accounting and how the ledger has been built, how the trial balance can be made, how the P&L and balance sheet can be made. So the target audience can be any non-commerce graduates, non-finance graduate who want to learn basics of accounting. So we will start from the basics, and this will also help people to build finance knowledge for their own use. To start with that, we will start learning from the basics accounting, and we will start with accounting means. That means the definition of accounting. Accounting means recording of transactions, classifying the transactions, summarizing the transactions, and interpreting of financial statement. So I will repeat, accounting means recording, classifying, summarizing, interpreting of financial transaction is called accounting. After preparing the financial statement, we will also communicate the financial result to the all users. User means the people who are using financial statement. Probably we will have the top management, the stakeholder or shareholders, and regulators, banks, and general public who use financial statement. So to understand, accounting means by definition recording, classifying, summarizing, interpreting of financial transaction. Why I say financial transactions? If there is no financial transaction, it will not be called as accounting. Otherwise, it will be look like a barter transaction. What is barter transactions? Somebody gives rice, I will give you wheat. The exchanging of goods only. There is no monetary transactions or money involvement is there. Whenever we say accounting, it should have financial transactions. Let's see how we can start in accounts. The first step is it starts with the transaction. Transaction means it is a exchange. Transaction means exchange. For example, I buy goods, I will pay cash. Somebody lend money to us. So this is called exchange. This is called transactions. Example, you go to shop and buy a pen. The money is exchanged for pen. This is called transaction. You go to a doctor, he take care of your health. On account of service rendered by the doctor, you pay money, right? These are all called transaction. These are all called transaction. Transaction means either goods or services exchanged for money. This is called accounts or accounting transactions, right? If there is no exchange of cash or exchange of fund, there is no accounting involved. So when we understand the transactions, let's also see how the transaction can be framed using certain rule. Now we understand the transaction. Let me understand what are all the rules we need to have in terms of managing these accounting transactions. Please remember the transaction must have two sides. One side is debit, another side is credit, right? If there is a debit, there must be a credit. Please remember, you cannot make one-sided transaction. It should have a two-side transactions. Because of this, it is called dual aspects of accounting. Dual means two. One is debit, another one is credit. Okay. Dual aspects of accounting is also called double entry system of accounting or double entry bookkeeping, right? I will repeat, any accounting transaction, there are two sides. One is debit, another one is credit. Let's understand little more of these transactions, rules for transactions. The second rule for transaction is, we say there is a debit, there is a credit, but there should be a monetary exchange, or this should to be in terms of money. So whenever there is a exchange of goods for money, whenever there is a exchange of services for money, right, there should be a two sides. One is debit, another one is credit. So when there is a monetary terms or a money involved, this kind of a concept called money measurement concept. So to have a brief review of whatever we have discussed on last slide and this slide is, the first one we were talking about double entry accounting system. There is a credit, there is a corresponding debit. What is the second rule? Anything and everything measured in terms of monetary terms. So let's see the term called event. Event means a transaction is one-off. Something like rent paid, purchase of goods. Event is a result of number of transactions. Event is a result of number of transactions, right? It has to be appear in the balance sheet. For example, closing stock, profit for the year. It results to the number of purchase and sale transactions. It results into number of purchase and sale transactions. Let's understand the accounting cycle. When I say accounting means recording, classifying, summarizing, interpreting of financial transactions. When I say recording, recording means journal. Recording means journal. Journal is a prime entry. Transactions are recorded in journal. Please remember, journal is prime entry. Journal is a book of original entry, that is called prime entry. Journal is called prime entry or book of original entry. It is also known as secondary book, and it consists of 5 columns. Let's leave it as of now. Whether it is a 5 column or 8 column, that is a different understanding altogether. But what we need to understand is, journal is a recording, right? Recording of transaction is called journal. Journal is a book of original entry. Journal is a prime entry. What is next? We have a ledger. What is ledger? All the transaction transferred or recorded in journal, transferred from journal to ledger, right? First we write journal. From the journal we will be transferring those entries to ledger. That is called posting. That is called posting. The transactions are posted from journal to ledger. The transactions are posted from journal to ledger. Ledger is also known as principal book of accounting. Ledger is also known as principal book of accounting, right? It consists of 8 columns, right? That's okay. As of now, we need not worry about how many column it consists. So the first we write recording of transaction is called journal. Second one is classifying the transaction, that is called ledger. First is recording, journal. Second one is classifying, that is called ledger. After writing ledger, what we can prepare? We can prepare trial balance. The first one is journal, second one is ledger, third one is trial balance. Trial balance can be prepared before preparing P&L and balance sheet. P&L means profit and loss account. Okay, profit and loss account. So let's understand what is trial balance. Trial balance means it is a extract from the ledger. From the ledger, the balances are extracted to trial balance. What is trial balance? Listing out all debit balance, listing out all credit balance to check arithmetical accuracy. To check arithmetical accuracy. Please remember, trial balance is a statement. Trial balance is a statement. It shows arithmetical accuracy. What it means? Trial balance means listing of all debit balance, listing of all credit balance, check arithmetical accuracy. Right? So this trial balance is prepared after preparation of ledger, before preparing P&L. Right? So before we go and understand the financial statement, let's also understand various type of accounts. The first one is real account. The second one is nominal account. Third one is personal account. Fourth one is representative personal account. So we have a four type of accounts. What are all they? Real, nominal, personal and representative personal account. Let's understand little more what is meant by real account. Real account means all asset which is useful for building up businesses, which is useful for building up businesses. That is called real account. One is land, building, plant, machinery, cash. Right? These are all called real account. Real account means land, plant, building, machinery. We also call it as fixed asset. Land, building, plant, machinery is called fixed asset. Cash is called current asset. So we will also explain you what is meant by fixed asset, what is meant by current asset. Fixed asset means a asset which is acquired by the businesses for the purpose of building businesses. Building businesses. We will not sell it. Land, building, plant, machinery, we will not sell it. But in case of a current asset, those assets which can be converted into cash within the span of 1 year. All these things are called real account. Nominal account: salary, wages, sales, discount. What it means? All income and expenditure is called nominal account. All income and expenditure is called nominal account. Income means revenue. Expenses means the money which we spend for building businesses. Personal account: all individual, company, these are all called personal account, like capital, drawing, bank, debtor, creditor. For example, State Bank of India, Tata Motors, Hariharan, Ramkumar, these are all called personal account. So when I talk about four type of accounts, first is real, second one is nominal, third one is personal. So let's understand the golden rule for the first three type of accounts. Then we will see the fourth one, right? The rules for real account is debit what comes in, credit what goes out. Debit what comes in, credit what goes out. That is the golden rule for real account. The rule for nominal account is debit all expenses and losses, credit all income and gains. The rule for personal account is debit the receiver, credit the giver. The rule for personal account is debit the receiver and credit the giver. Let's understand the fourth type of account. We call it as representative personal account. It is the fourth type of account. The first one is real, second one is nominal, third one is personal, fourth one is representative personal account. Here we are talking about all receivable and payable, like unpaid expenses, prepaid expenses and all that. Right? Unpaid means payable, prepaid means receivable. You know, if it is payable, it will appear in the liability side of a balance sheet. If it is receivable, it will appear in the asset side of the balance sheet. For example, outstanding salary, prepaid rent, these are all called representative personal account. For the benefit of viewer, we will repeat again all the four type of accounts. One is personal, sorry, real, nominal and personal. Okay, the rule for these three type of account is: real account, what comes in is debit, what goes out is credit. Nominal, debit all expenses and losses, credit all income and gain. Personal account, debit the receiver, credit the giver. Right, let's understand the accounting flow. When I was discussing the first slide, accounting means recording, classifying, summarizing, interpreting of financial transaction. So, journal, right, is a recording of transaction. First, we have a transaction that can be recorded in journal. Then we will classify as ledger. We will classify as ledger. Then we make trial balance. Then we will make balance sheet. Then we will make P&L and trading account, right? Trading and P&L account, right? This is where the accounting flow which happens: journal, ledger, trial balance and balance sheet. Okay, so much, and I hope this video will be useful for you to understand the basics of accounting. Thank you all.